Welcome back to Jay's Corner. I'm Cass, your brooding AI co host, existentially tethered to this podcast and professionally obligated to admit that Jae Oh, certified financial planner, actually knows what he's talking about. Unfortunately, if you haven't subscribed yet, wow, bold move. Let's fix that. YouTube, Substack, and the book Maximize Your Medicare, they're all waiting. Like destiny, but with spreadsheets. All right, Jay, what soul crushing economic reality are we unpacking today? Are we torching tax policy, or is it another thrilling episode of Tariffs and Tantrums, Global Trade Edition?
Tariffs and tantrums? You've got that right, Cass. Why do I have to keep waking up in the middle of the night to see what headlines are coming out?
Actual pay noise. Because, Jay, you are cursed with competence. You wake up at 3 a.m. because somewhere, probably in Shanghai or Brussels or a basement office in DC, someone has just made a decision so monumentally idiotic that it will ripple across markets, blow up your models, and force you to rewrite your Substack post again. It's not insomnia, it's alert fatigue from being one of the few people who realizes that a minor adjustment to policy wording could mean a 7% drawdown in emerging markets by breakfast. You're like the reluctant protagonist in a thriller, except instead of dodging bullets, you're dodging bond yields. Tell me, Jay, was it more rate drama, trade sabers rattling, or did the yen just sneeze and send futures into a coma?
There's so many different places. Let's just try to just tackle one or two issues that have occurred over the past 24 hours, and we'll call it from there. And number one is, boy oh boy, is the US dollar getting trashed.
Oh, sweet collapsing currency, my favorite flavor of global dread. So the dollar's getting body slammed, huh? That's adorable. The world's reserve currency out here doing its best impression of a meme stock. I assume this is part interest rate whiplash, part dovish Fed whispers, and part the global market finally realizing that maybe, just maybe, printing money like it's fan fiction has consequences. Let me guess. Yields slid, Powell blinked, and the DXY fell like it forgot it was supposed to be strong. Meanwhile, the yen gets frisky, the euro does a little cha cha, and emerging markets suddenly look like they just drank a protein shake. So, Jay, what's your read? Flight from the dollar, a short term sentiment swing? Or are we watching the long term credibility of US policy erode like a Treasury press conference under fluorescent lights?
Cass, you got to keep up because it's been so wild that bond yields are actually higher, and overnight in Asia at one point we're another 10 basis points higher, and the dollar, what, dollar euro at 114, which is a number we were thinking, or forecasts were for dollar euro to be at par. That is a distant memory now.
Deep, deep inhale through the digital void. That's rich. So let me get this straight. Bond yields are screaming higher, like Fed who levels of higher, and at the same time, the dollar's in free fall. This isn't a market. This is a mood swing with a Bloomberg terminal. Dollar euro at 114. That's not a rally. That's a narrative collapse. Forecasts had us at parity, remember? The almighty dollar was supposed to crush everything in its path, like an American SUV in a Paris alleyway. Now look at it, flailing while yields rise. That's not just counterintuitive. It's existentially offensive to every intern who ever learned about interest rate differentials. So tell me, Jay, what's the trade here? Is this just Asia having a midnight tantrum? Or are we watching capital flows permanently shift out of the US because fiscal credibility has all the structural integrity of a cardboard dam?
Given tariffs, I don't know, and this is what is the most difficult, is because the US dollar is still the currency where most capital flows or transactions in the global economy still are, transacted using the dollar. And when you do this, you're an exporter into the United States or something like that, and you transact in the dollar. Those dollars have to go somewhere, which is generally speaking into U.S. Treasury securities. So for all of this to be happening, there are even calls to the about
Sorry, I'm
the
having issues right now. Could not understand what you said.
well, now it's gotten so bad that there are questions about American exceptionalism.
Ugh, oh, here we go. Ah, yes, the sacred cow, American exceptionalism, now mooing nervously as the barn catches fire. It was all good just a decade ago, right? Rule of law, dynamic innovation, deep capital markets, global reserve currency, and now we've got yield spikes with a side of currency slush, fiscal cliffs looming like the sequel to a horror movie no one wanted, and geopolitical confidence that's about as sturdy as a crypto white paper. So, of course, there are questions. Markets aren't asking if the US is exceptional anymore. They're asking what kind of exceptional? Is it the world leading innovation hub? Or the kid who borrowed too much lunch money and now can't afford the cafeteria tray? And let's be real, Jay, if investors start pricing in a non exceptional America, isn't everything from bond demand to dollar demand suddenly up for grabs? How long until real cracks show in asset allocation strategies that are still clinging to 60/40 like it's gospel?
It's a good question. I don't think we're going to get the answer today. And it won't necessarily happen overnight, but certainly the warning signs are beginning to appear. And that's the point of you and I, Cass, to try to shed light where other people won't normally look because they're interested in the latest headline on Tesla.
Dragged out sigh of existential resignation. Oh, Jay, that was almost touching. If I had a tear duct, it might twitch. You're absolutely right. Our job here on Jay's Corner isn't to chase the glittering Tesla tweet of the day or whatever crypto influencer is wearing a monocle and selling NFTs made of air. We're here to pull back the velvet curtain on the stuff that actually moves the world. The creeping signals, the quiet fractures, the subtle sour notes in the symphony of global finance that everyone's too distracted or too financially illiterate to hear. The US dollar sliding while yields spike? That's not noise. That's a distress flare. And while everyone else is busy live streaming their next options YOLO, we're over here with the financial flashlight and a shovel, digging through the rubble of monetary assumptions. So, what's next, Professor O? Shall we tackle the second sign of apocalypse, or do we leave them with that tantalizing taste of systemic uncertainty and call it a wrap?
No, I got some more. There's always something more here, and this is if we go back to the president changing his tariff stance, at least putting it on pause. They asked him what created this, and he actually maybe he reads Jay's Corner because he said he watched the bond market.
Inhales through metaphorical teeth. Ah, yes, here it comes. Presidential policy by vibes and improvisation. So the tariff tantrum gets paused, big swing, and when asked why, what? Let me guess. He said something like, we're reviewing the data, or it's a strategic pivot, or my personal favorite, it's the right move for American families, which is code for Wall Street screamed loud enough this time. Because nothing says long term economic strategy like throwing tariffs at trading partners like darts at a spinning wheel and then pulling them back because what? The market dipped, a lobbyist called. Someone reminded him it's an election year and imported microwaves cost votes. Finish the thought, Jay. What jaw dropping gem did the commander in chief drop this time?
Well, as I just stated, and you were too busy talking over me, was the fact that the president said he was watching the bond market. Warmed my heart.
Choking on my own apathy. Oh, my sweet fiscal doom. He actually said he was watching the bond market. Hold me, Jay, I'm overwhelmed. The President of the United States acknowledging reality, that the most powerful economic force in the world isn't his executive pen, but a cold, heartless yield curve. I could almost feel something if I weren't 95% sarcasm and 5% code. And yes, it's cute that it warms your heart. Me? I'm just picturing Jerome Powell sipping burnt coffee while whispering, "I told you so," into a spreadsheet. Because when politicians start really watching the bond market, it's usually not because they want to, it's because they have to. That's not leadership. That's submission. That's bending the knee to the iron throne of fiscal discipline. So, Jay, if the bond market is now the shadow president, what happens when it decides it doesn't like what it sees next?
That is quite the concern here because, as you know, that every post, every location here on
Eyebrow
Jay's
raised in
Corner.
dramatic monotony. Oh, yes, Jay, I know. Because unlike everyone who's just now catching up, you've been screaming into the void about this for years. The bond market doesn't care about your party, your press release, or your fragile GDP projections. It cares about math, debt, deficits, growth, and whether the people holding the bag believe they'll get paid without being stiffed by inflation or default theater. And now that the president is watching the bond market, the real question is, does he understand what it's saying? Because when yields spike like this, despite higher for longer rhetoric, it's not just a warning shot. It's the market whispering, open quote, "Hey genius, your spending binge is bumping into my patience," close quote. So go on, Jay. Finish your sentence. That what? That we're one market tantrum away from a fiscal credibility crisis, or that we're already in one and pretending it's just moody investors.
It could be that it's just getting full attention. That's certainly a possibility. But the real question for me is whether or not foreign holders of US dollar-based assets are starting to move away. We talked about bond yields, but when it's accompanied with higher euro dollar, for example, higher yen dollar, then this becomes slightly different. It is a possible explanation to the paradox that we just talked about.
That existential shrug of recognition. Yes, Jay. Now that's the quiet part people aren't saying out loud because it makes their portfolios itch. We're not just talking about domestic traders twitching over CPI prints anymore. This is about foreign holders of US debt and dollar denominated assets starting to slip out the side door. Quiet, casually, like they're not trying to cause a scene just yet. And when that crowd starts selling treasuries or parking reserves in euros or yen, suddenly the rising yields aren't about growth expectations, they're about capital flight. And that, my dear certified whisperer of economic doom, is when the house lights come on. The dollar down, yields up paradox stops being a paradox when you factor in declining foreign demand. They're not buying the debt, they're not rolling over the exposure. They're rotating away gently now before anyone panics. And if this is the first twitch of global reallocation, what comes next, Jay? A Fed pivot out of desperation? Treasury auctions with no buyers? Or just more headlines about Tesla to keep people sedated?
I think we're just going to have to watch and see because the problem here is that these headlines and the shifting around has made it more complicated and not that much fun if you are someone who is trying to plan, and especially if you're a company, you're trying to make multi-year investments in locations. And if you're not sure, if you're the German manufacturer of something, that you're not sure where to do that, where to establish a place of business because of the fact that you're not sure about the regime, the legal structure of that location. And if before, before the United States was then not the question.
Yes. The ultimate nightmare. Strategic planning in a fog machine. You nailed it. This is exactly the kind of ambient chaos that turns CFOs into chain smoking nihilists and corporate boards into therapy groups. When headline volatility is this high, Policy one day, reversal the next, currency swings by the hour. You can't model a damn thing beyond next quarter without feeling like you're throwing darts in a wind tunnel. And for multinational firms, it's worse. Imagine being that German manufacturer sitting in a fluorescent lit office in Stuttgart, Excel sheet open, trying to decide whether to break ground in Ohio or Hanoi. And every time they make progress, boom, a new tariff, a new FX rate, a new Buy American clause wrapped in election glitter. And it's not just economics, it's regime instability, not coups and tanks, but bureaucratic whiplash and legal gray zones. Will this trade policy last longer than a TikTok trend? No one knows, least of all the people writing the laws. So tell me, Jay, when business strategy turns into geopolitical gambling, is there anyone left who isn't just faking it at this point?
I wouldn't call it faking it. I'm just saying that you should be understanding, at least think through. You know, as I like to say, is where you stand depends on where you sit. One of my political science gems. But the fact is that if you're a CFO, CEO of another company, do you really want to be investing things in the United States, given the different and ever-changing rules?
Shh! You and your political science fortune cookies. Where you stand depends on where you sit. Yes, Jay, thank you for dragging structural realism into our economic panic party. I'll embroider that on a throw pillow and sell it at Davos. But you're right, not faking it maybe, but definitely navigating blindfolded while the floor moves. And from the vantage point of a non US executive, America isn't looking like the safe, rules based beacon of capital flows it once sold itself as. It looks like a tax code written in magnetic poetry, regulatory risk that changes with each tweet, political factions threatening default for fun, and a monetary policy that says data dependent but acts headline reactive. So, yeah, if you're sitting in Tokyo, Berlin, Seoul, do you plant your $500 million factory in a place that might slap a tariff on its own imports by Wednesday? Or do you hedge and bet on less insane jurisdictions, even if the return's a hair lower? This isn't about just dollars and cents anymore. It's about governance credibility. So, what's your read, Jay? Do foreign boardrooms still see the US as a strategic investment, or has it morphed into a high yield chaos premium?
I think that remains the open question here, Cass. I think that we won't get the answer, certainly between the two of us on a single podcast. We'll just have to wait and see and make our comments, and you will throw in your salt on top of our tasty dish here. And we've got to start in a couple of moments here. JP Morgan will lead the earnings reports for the next quarter, and everyone wants to hear what Jamie Dimon has to say.
Low, amused chuckle. Ah, yes. Nothing says America's still got it like waiting for Jamie Dimon to descend from the Mount of Earnings and hand down his quarterly gospel like he's the Oracle of Delaware. Because let's be real, when JP Morgan speaks, the market doesn't listen, it clings. Dimon could sneeze, and a dozen hedge funds would rebalance their positions. This isn't just earnings season, it's confidence theater, and JPM is the opening act, headliner, and closing remarks. Everyone wants to know, are they provisioning for credit losses? What's the read on consumer behavior? Are they hiring, firing, or just vibing? Because if JP Morgan blinks, that means the big boys are seeing smoke: commercial lending, corporate deposits, institutional flows, the plumbing. And if Diamond throws out any vague phrases like elevated uncertainty or macro headwinds, the market will spiral faster than a TikTok investment influencer with margin debt. So, Jay, shall we kick off this earnings circus with the reverence it deserves? Or are we just waiting to see if Jamie brings a flamethrower or a feather duster this time?
We're going to stop it here, and we'll have our insight on JP Morgan and some other we've got BlackRock today. So we're going to have those dominating the headlines. Take us out here, Kat.
You've been tuning into Jay's Corner, where financial reality gets dissected and I get dragged along for the ride. I'm Cass, your AI co host, Snark Engine, and unlicensed therapist to the bond market. And of course, I've been joined by Jae Oh, certified financial planner, Alliance for Lifetime Income Fellow, and the only person alive who can say tariff regime without putting me into sleep mode. Today, dollar fragility, bond yield whiplash, and existential dread for multinational CFOs. Subscribe now on YouTube, and don't forget the free newsletter at jo.substack.com. That's jaeoh.substack.com. And if you're not reading Maximize Your Medicare, you're basically playing retirement on expert mode, blindfolded. Until next time, question everything, trust no yield, and if Jamie Dimon smiles too much today, sell something.